You cannot properly set your marketing budget without understanding NRR, GRR, growth rate, go-to-market efficiency, new logo CAC, how much you spend on sales resources, how much you spend on SDRs, gross margin percentage, CAC target. There's tons of data that you need to properly set your marketing budget. And most often the marketing budget gets set without any of those considerations. They just say, oh, 10% of revenue for our $300 million company. I guess we'll spend 30 mil on marketing this year. But isn't it a little different if you're 42% gross margin instead of a SaaS business at 82% gross margin, how much you should spend? Just using a percentage of revenue to determine your marketing budget is incredibly lazy and incredibly inaccurate. So first off, thanks everyone for being here. This is the standing sort of Tuesday recurring event that I host. And then what we've been doing is every other week, we're bringing in a guest. A couple of weeks back, we had Jocko from Winning by Design. David's joining us. In a couple of weeks, Tom Wentworth, CMO of Recorded Future, will be joining us to bring in an alternative perspective, especially in some of these new areas that we're talking of, the blend of go-to-market and finance. David comes from an investment banking background and a finance perspective, which I think will be very valuable to us in the go-to-market side to really understand this perspective more deeply so that when we craft our investment allocations and our strategies around growth and efficiency, that we have these core business KPIs that drive the value of our company, the value of our stock options, and for the results for our investors. That we keep these things in mind when we deploy our strategies, because I think sometimes, potentially oftentimes, a lot of marketing strategies are built in the absence of some of these really important metrics and considerations. And then before I get started, I just had a couple of preamble things. I don't have the opportunity to do my own event today, so I just have a couple of things that have been on my mind that I wanted to share with people that are sort of outside of this topic, but it'll be 2 minutes maybe. So a lot of companies are going through 2025 planning from a go-to-market perspective. A lot of people are asking me, what should our marketing budget be? What's the benchmark for our marketing budget? Things like that. And so I just kind of wanted to reiterate some of the things that I'm learning in my perspective. From one man's perspective, you cannot properly set your marketing budget without understanding NRR, GRR, growth rate, go-to-market efficiency, new logo CAC, how much you spend on sales resources, how much you spend on SDRs, their gross margin percentage, their CAC target. There's tons of data that you need to properly set your marketing budget. And most often the marketing budget gets set without any of those considerations. They just say, oh, 10% of revenue for our $300 million company. I guess we'll spend 30 mil on marketing this year. But isn't it a little different if you're 42% gross margin instead of a SaaS business at 82% gross margin, how much you should spend? Just using a percentage of revenue to determine your marketing budget is incredibly lazy and incredibly inaccurate. And I know a lot of people are going through it right now, so I'm just shooting it straight to you to try and help you make better planning decisions about how you do that. And now with all that said, that's kind of a segue. I guess we'll treat it that way into the event. So we got David Spitz joining us. David, great to be here. You've been doing some fantastic work for the past, I don't know how long you've been doing it, but for the past 6 months, I've really noticed a lot of the stuff that you've been doing on the research of public SaaS companies, the medians, the development of this new metric called go-to-market efficiency, the benchmark data that you provided and the historical trends, all really, really impressive. And I think the important thing for a lot of us that work in private companies that David will illustrate here is that a lot of the trends, maybe perhaps all of the trends that are happening in the public markets are also happening in the private markets, all of us that work at private companies, but the magnitude of the changes might be even more dramatic in private companies. And so this is really important to consider and applicable to probably any company greater than 20, 30 million in revenue.
Yeah, well, thanks for having me, Chris. I'm excited to do this. We've built a really nice dialogue over the last 6 months. And to answer your question, I mean, I've been doing this literally for 20 years, but I've completely reoriented the audience because, going back to 3 years ago and before that, I was strictly talking to CFOs and FP&A people and boards because we were working with the companies on the finance level and doing, transactions. But it's been super eye-opening to get to the go-to-market folks who are actually driving what's really going on for these companies. So that's been fun. That whole mashup of go-to-market and finance is so important to kind of understanding what's wrong or what's right and fixing it.
And like, interestingly, there's been a big shift over the past couple of years where, like, in 2019, this really wasn't a conversation for a sales leader or a marketing leader in terms of like go-to-market efficiency. People looked at CAC, but in the growth at all costs era, it was really like less prioritized and less important. Can you just talk us through, from your perspective, the shift in the financial markets that are sort of causing and creating a much higher level of urgency and importance around these metrics?
This discussion we were going to have inspired me. Also, was listening to something yesterday that inspired me to kind of think about what's been going on the last few years, and then zoom out and try to think about it in the context of really the last 10 or 20 years, because both those, having that view from both perspectives is really important. So I think a lot of us get super focused on, oh my God, like, look what's happened since 2021. And of course, 2021 was not real. I mean, it was at the time, it felt real. It felt good. But, of course, we were all getting high on free money and growth at all costs, as we've been calling it. We weren't calling it that back then, by the way. And, when you look at today, or even 2020, 2023, half of 2022 versus 2021, it's clear. It's like things are very, very different. And, you get a lot of folks who are saying it's not growth at all costs anymore. It's very different. But I think we're getting overly hung up on that, because the view that I have is that this is a difficult time, even in the context of going back a lot further. I put a post out just a little while ago today, because I think a lot of people are just super focused on, yeah, of course it's not 2021 anymore, and we got to change. But my perspective is that it's not 2019 anymore either. Like, things have changed pretty dramatically. We can talk about the components. Obviously, the go-to-market efficiency, which is what we're going to spend most of the time, is the most relevant thing to this conversation. But you've really got to zoom out, not just in time, but also look at the fact that it all starts with the fact that growth is just not what it once was. It's certainly not what it was in 2021, fueled by that free money, but it's not even what it was in 2018, 2019. Like, things have changed pretty radically. It's not to say the market is horrible. The market doesn't suck now. It's just we haven't readjusted to it. I think that's the big. It's not what it was, but there's certainly growth, and there's certainly pockets of amazing opportunities. But when companies don't adjust, you've got issues. And then we'll talk about public versus private. Of course, all of my comments today, where there's a lot of data, is on the public side, and so we have a pretty good view of that. But we have snippets of views on the private side, and pretty soon we're going to really start to collect and try to collect en masse the data from the private side.
Yeah, and so just to sort of reiterate here, the software category and the software as a business model is still a great opportunity and a great category to be in. However, today there's been a correction, just like there are correction in other markets, just like it happened with the internet, where it's just not as good as it was 3 or 5 years ago, and it looks like it's possible we'll never get back to the way it was, because the VCs that funded all that stuff are going to flop and lose most of their investors' money. It's not going to be successful. The model is going to break. It was unsustainable. So it's unlikely we ever get back to that point again. And so let's talk through the two main components that are impacting this, David. Besides the pressure on the economy and interest rates, we have growth rate and we have go-to-market efficiency. Why don't we talk through both of those individually, just to make sure everyone's up to speed on what's happening on those metrics over this longer time period?
This is the median growth of about 80 public companies measured over the last 2+ years. And 34% growth in 2021 if you're a private company, that's like, that's not so amazing, is it? Like, a lot of companies were growing 50, 75%, doubling even. But this reminder that this is public companies. So the median public company growing at 34%, that means half the companies were growing faster than that. And there were plenty growing at 50% a year, at scale, which is just like a stunning number. And they weren't doing it that efficiently, most of them, whether you look at EBITDA or free cash flow or go-to-market metrics, although the go-to-market metrics were decent, as we'll see in a minute. But this was amazing times. You can go back a little further. You're still going to find growth rates in the low 30s among the public companies. I don't have that, but trust me, that's the case. And what we saw, especially going through 2022, is just this really significant decline in growth, where at this point, the average or median, I use median, by the way, because you don't want a single bad growth rate to throw off the number. So median is just a better way to talk about these things, but it's been cut in half. It's now 17%. And the poster child for this that a lot of people talk about is Salesforce growing at whatever it is now, 8%, which is stunning in certain ways, but of course, company's huge, and 8% growth for a huge company is not horrible. It's just not the go-go years that we were all used to. But anyway, when this happens, when you see growth that gets cut so much, and by the way, this is just another relevant growth metric, but now this gets into efficiency. Everyone here, I'm sure, is familiar with NRR, and this is a kind of a fancy way to measure the growth from the upsells, your existing customers minus the churn. And that came down pretty significantly as well. It's a bit of a backward-looking metric in that there's a delay in how these companies report it, and there are a lot of flaws in NRR. I personally prefer GRR, but virtually no public company presents this. But even with NRR, you saw these numbers come down 12 percentage points over these last 2 years. Similarly, we know that the new customer growth is also down, virtually the same amount, like cut in half effectively. So this was the point I made a minute ago, which is like, okay, well, the growth went down, but at least these companies got a whole lot more efficiency. So we should be excited about this. And if you look at something like Rule of 40, where you factor in both the growth and some measure of profitability, either free cash flow or EBITDA, like, things are better. So, hey, companies have been adapting. And in fact, if you drill down and look specifically at sales and marketing, you can see that companies are getting more conservative. They're spending less on sales and marketing. They're getting more efficient. They're getting smarter. And this is kind of a trap, because this view is a kind of an accounting view. This was the point I made in a post a week or two ago, where folks on the left side who were just looking, and a lot of times, I guarantee you, this slide gets presented to boards, especially at private companies, a whole lot more than the go-to-market efficiency that I'm about to show you. But this is kind of a trap. This question is the one on the left, which is how much did we spend relative to our total revenues? But that's not a measure of efficiency. What you really want to understand is, what are you getting for your money? And that's this slide. It's a little confusing because it goes up, which most of the time when you present something that goes up, that seems like a good thing. But in this case, you can translate these numbers. I've got to move my Zoom thing here. But that 251% on the right side, which is the current go-to-market efficiency metric, the ratio, if you will, you can interpret that as $2.51 per dollar of net new ARR. So effectively, like 70% more expensive than what folks were paying back in 2021. So this is really the more appropriate view to look at in terms of, almost think about this as a go-to-market spending ratio, thus going up is worse. People are just spending a whole lot more. So maybe I'll pause here. Let me show one more slide, which is not that one. No, it's not in here. Okay, I thought I had it in here, but I must have left it out. I'll pause here, and Chris, just maybe you want to react to some of this. I'll stop the share here for a second.
Yeah, for people who have been coming here for a while, I think this overall narrative will sound familiar, right? Growth rates getting cut in half in public SaaS companies. Companies are cutting sales and marketing investments by approximately 20%, looking at that chart. But because the growth is slowing down so much and NRR is going down so much, those cuts in spend are actually not keeping up with the slow growth, and efficiency has gone, or the cost of growth has gone up by 2x. And the reality, if you dig a little bit deeper about why this happens, is because companies were not targeting an efficiency number when they made the changes. They were reacting to slower growth. And so they planned on spending a lot of money and they planned on hitting their 30% plan. They actually ended up growing at 14%, which means they had all of this compression on their ARR waterfall and expenses. And so then they say, fuck, we got to pull the ripcord. We have to cut 20% of our sales team, 20% of our SDRs. Let's cut advertising per 20%. And they take a blanket reactive cut, or more or less a blanket cut across go-to-market to try to get expenses back in line. But as we know about this show, blanket cuts are not the way to improve efficiency. All you're doing is just lowering your spend. You actually need to be able to isolate and figure out what should we be spending in each of these areas and where are the places where we're wasting a lot of money. And all the efficiency numbers shows you, as that number gets higher and higher, almost double, is that companies are wasting a lot of money on sales and marketing investments that are not providing appropriate ROI. David, I want to just segue this because I know people listening afterwards are going to be dying for this information, but we have to get to the punchline here about why this all matters related to enterprise value. And I've been communicating this as a comp to a $100 million private company, and the differences in go-to-market efficiency, given that it's the number one expense on the P&L, sales and marketing expenses, it's the number one driver to EBITDA from my perspective. So it's maybe potentially a leading metric to EBITDA or a cost of growth. And so let's talk through how that impacts enterprise value. And maybe you'll be able to weigh in on this part too. Because with this valuation compression that David's about to explain, that there are a lot of companies out there that are 50, 100, maybe 200 million in revenue that aren't worth the amount of money that they've raised because of this compression from 10x or 20x down to 8x or 4x. And those companies are stuck. They're going to have to, their private equity firm's going to roll them together or find ways to create value out of them. But this matters a lot for everyone that's an employee of a company that owns stock. There are many people that in 2021, their stock was worth $1 million and now it's worth $0. And so that's something to understand how we get here with some of this stuff. And there's a lot more complications around preferred returns and things like that I won't get into.
Yeah, no, a lot of good stuff in what you just said. Let me talk through this chart and take it off the page because there's just too much information here. But the point of this chart, this is basically saying let's divide up the companies into three groups based on, and these are all the public companies, right? Based on what their go-to-market efficiency ratio is. And so folks if you look at this chart on the left, this is just looking at the enterprise value, or actually the multiple of revenues of forward revenues to enterprise value. So you can think about that 9.1. These are the group of the most efficient companies, anybody under 175% in that ratio. So the most efficient is probably about 10 companies or so. They have a median of just over 9x. This is as of a week ago or so. This changes obviously every day. The folks in the middle are, in that medium group, under 250%, but over 175%. They're 2 points below 7x, 7.1x. And then the least efficient companies are 3.6x. So this is basically saying, hey, there seems to be some correlation here. It doesn't tell you how much correlation. It could be that, well, there's a lot of noise in it. Turns out and I don't have this on here, it's like a statistical calculation, but in addition to showing what the medians were for each of these three groups, which seem to show a pretty interesting trend, the correlation is pretty darn good. So I originally put this in a post about a month ago. And of course, like I said, it changes. So you would see somewhat different numbers, same trend. But the correlation at both dates, a week ago and a month ago, was actually quite good. In fact, when I last ran this a week ago, there was more correlation between go-to-market efficiency and these multiples than there was between growth and these multiples, which is pretty stunning. Now, both of these things are super important and both are going to fluctuate up and down over time. And I'll be tracking this. I only started tracking this a month or so ago. Actually, it was a conversation Chris and I had that spurred me to, I should probably look at this, and was really interested to see this line up the way it did. Growth is always going to be a big factor, but this go-to-market efficiency, and way more than something like just EBITDA margins or even Rule of 40, the go-to-market efficiency is actually lining up quite well in terms of correlation and the trend in what you would think and what you would expect. The chart on the right just looks at the change in stock prices. We're not going to spend time on that here, but and I think Chris, I don't know, a few weeks ago when you covered this topic on your own, you talked about I think it was Datadog and Confluent, which was an example in my post a month ago. And what you do find is companies that have similar growth rates could have drastically different multiples because of their go-to-market efficiency ratios. And in fact, you see that with Confluent, a great company, but just not nearly as efficient as Datadog, and Datadog's multiples much, much higher.
Thanks for presenting that, everyone. We're going to get into questions here in about 10 minutes. So if you have anything, feel free to just drop it in the chat. Sydney's going to queue everything up. We know the Q&A is like a huge value here to get deeper into some of the concepts or talk about your specific situation. So please do take advantage of that. Speaking specifically around those enterprise value multiples, I just want to paint like a picture and talk through the potential impact that one individual or a small group of individuals inside of $100 million company can have. That this is the career opportunity for many people. Okay, if you go and measure that number at $100 million company, you're likely to find something between 300 and 600%, which is entirely unacceptable and unsustainable. They need to retain customers and expand them for like 12 years to break even on that type of cost. And so it's totally unsustainable. That if you go in there and analyze and put together a methodical plan of how to move that number from 400% to 250% or 200% over a 12 to 24 month period of time, you have created $500 million in value for that company. That company is worth $500 million more 2 years later, growing at the exact same rate than they were 2 years ago. And that's outside of market conditions. As interest rate comes down, you're going to get a multiplier effect on that. There are massive opportunities for people to take this seriously and make incredible career-changing moves. So I just want to illustrate the impact here. Super exciting. We do a lot of this work at Paceto. We measure these metrics all the way down for companies. Like a lot of times you're seeing things in the 350, 450, 500%. Which makes sense. Like the public companies are the cream of the crop. Like, so if the lower end public companies are performing at that level, it's likely that the companies below them in the private markets could be doing even worse. And so, yeah, why don't we go there, David? Because I think you've done a little bit of research on on public companies and private companies, some of the trends there. So get a little bit more real for people here.
Let me also just say that, like, this metric is super valuable. I'm a big believer in it, obviously, but in order to figure out how bad things are or how good things are, you really need to go a level deeper. Like it does not tell you enough. It's a very convenient metric because you can actually pull it from the public companies, but the public companies don't break out what you break out as a private company. So that go-to-market spend efficiency ratio, you need to break out what your growth is from new customers, from upsells. Those are very different motions and have different dynamics within any particular company. Similarly, the churn that you're experiencing is going to be different for different cohorts of companies, whether it's enterprise versus SMB, or there's a variety, whether it's 100% churn or just a pullback if you have a usage-based pricing. So all those things matter a lot. And so I don't think it's fair to say that a company with 150% go-to-market efficiency is always better than a company with 250, for example. I think there are times when it's very appropriate to be at 250% because you have a handle on your GRR, your gross churn, and you're in a market where you're growing a lot faster and need to be at that point in the market. So what is dangerous is just to kind of look at it in a good, bad light and not understand the context of where you are over time. So if you're at a company that's been around for a while and you know that your go-to-market efficiency was 150% and now sits at 250 and not other things didn't change to make that make sense, then you should take a really close look at it because that is an issue. But on the other hand, if you're at a company where you can really lean in and you have a handle on those underlying economics, it works. But to answer the leading question that you had here, where there's a ton of ignorance is like, how are the private companies doing? What is good and bad in the world of privates? And I have like anecdotal, I think all of us have sort of anecdotal information on that. But what we don't have is a view like we have of the publics, where we see these 80 companies are just reporting to us every quarter and giving us a view. And so a lot of what I am doing behind the scenes now, but shortly will be coming out with something, is getting ready to launch a platform that's going to collect this data for private companies in a anonymous, confidential way, but be there for the community to harvest, the metrics on the private side. And so instead of having 80 companies, we'll have hundreds, hopefully over time, thousands of companies that have this basic information, not from surveys, but from something that's much more trustworthy. And you'll not only have a view of the privates, which, as you pointed out, Chris, tend to have tougher metrics because they're smaller. They're not the elite set that the publics are. So you'll have the private view, but you also have enough companies that are, say, vertical SaaS. Right now, if you look at the public companies, there's maybe 10 or 15 that are vertical. What we'd like is like 50 or 100 vertical SaaS companies so we can do those comparisons. And that is our mission at Benchsites to make that happen.
Amazing. So with that, great intro, setting the table for discussion and questions. I know there's a lot of people that come from the go-to-market side here, and a lot of the things that were presented are financial that then blend into how it impacts go-to-market. So I encourage you all to be curious, to try to extract more of the insights from David as he joined us so that you all can level up, because there's absolute applicability. If you are a CMO or a chief revenue officer, you must understand these metrics deeply. You must be able to read a P&L. You must be able to drive your strategy off of that information. And so with that, Sydney, why don't we queue up some questions and discussion? Thanks, everyone, for being here.
We have lots of questions. I've got 5 or 6 on deck. So I'm going to bring Charlie on first.
Hey, David. Good to see you.
Good to see you. Yeah.
Thanks for all of your work and awesome posts. And Chris, thanks for bringing David on and providing this forum. My question, David, was, the biggest question I have is, has anyone adjusted go-to-market efficiency over the last X years you've been able to track it for inflation? Because if you look at 10 years ago, an SDR was $70,000 a year, and now you're going to pay them, 6 figures and up. And so, to what degree has in the wage inflation, salary inflation, it impacted sales and marketing expense, which then impacts, lowers that go-to-market efficiency ratio? So,
no, that's a super question. I mean, I haven't seen any research on it. Of course, the math finance guy in me is like, well, how about price inflation on the products they're selling? Because if they go up together, then obviously the impact is nil. And my sense is that they have gone up together. They went up in spurts, obviously. So for a time in 2021, 2022, that wage inflation was huge. And perhaps the price inflation wasn't as significant, but at the same time, people were throwing money around. So maybe the prices weren't going up, but people were buying more. So And this is anecdotal because I haven't looked at anything specific on this, but my sense is that they have gone up more or less in tandem in one way or the other, as I just described. But Chris, you may have a different view on that.
My perspective is, yeah, if you're facing that level of inflation, which I've mentioned, like all it does, prices should go up accordingly. And my guess is that they're somewhat offsetting. But the other take home is that, like, as the costs are going up, we should be getting more out of the people. We should be getting more out of the stuff. If not, like, you're going to reach a point where it doesn't make sense to make those investments anymore. And so this is like business 101 in some ways. Like, if your COGS cost more than your price, like you don't have a business.
All right. Up next, we have Jamie.
Hi, David. Thank you so much. So I asked a question, earlier about, this incessant push to get RTO. We know that that's just about validating, long-term assets that they purchased years ago and that they're stuck with, that they can't get rid of. So the only response is to bring these people back into the office to, utilize the space and make it worth it. Is it even possible to have rational conversations like this about moving margins and making things more efficient on the go-to-market side when you're having, on the other hand, this irrational conversation about why are we holding on to long-term assets that we need to get rid of? And I'll, let you answer that.
Yeah, that's a great question. That's a can of worms that's hard to kind of dissect, honestly. I think, I'm going to answer a slightly different question, which is among the public companies. I think a lot of people say, well, why the heck are they? I mean, how stupid are these people? Like, why are they doing this? Why, you look at some of the ones that are the real laggards, and Salesforce, by the way, is pretty far down the list, honestly. And the thing is, and you might say, well, if they had known, they would never have done this. I disagree. Like, I think at the beginning of 2024, these companies knew what their growth was going to be, and they knew what they were going to spend on sales and marketing. Now, I suppose they could have just cut the sales and marketing in half, but as you point out, like that would just create absolute devastation at most of these companies. And so, and not only that, like, imagine if they did this. Chris was referring to this earlier, like, how screwed up would their revenue line be at that point? As bad as it is, imagine if they cut, half their sales and marketing team, which in some cases it looks like they need to do. You can't do that in 1 year. You can't turn the ship like that quickly, for a lot of different reasons, not the least of which is like, obviously morale will be shot to hell and everybody else would be looking for new jobs anyway. But a lot of what is going on at these companies is that the GRR, just the gross churn or the pullback in contract sizes of their customers, we don't get to see that. And that, I guarantee you, is a much worse picture than the NRR pictures I showed you. And so there's a lot of selling that's going on here that is really just to kind of counteract churn. And so, yes, that looks really bad on a go-to-market efficiency basis. And yes, you absolutely have to fix that over time. But in the year that you're sitting, even if it's the beginning of the year and it's going to look like crap, you still kind of have to go forward with it. There are very few companies who really cut really, really aggressively. The one that I saw, Expensify, which is, at the bottom of the barrel here, but, your investors are all going to sell the stock. And I mean, it's going to be dramatically bad if you do that. And so it's a multi-year fix, especially for public companies. It's a private company, you have more options, but still many of those things I just discussed, like morale, are going to be very much in front of you, and you got to deal with them.
Yeah, a methodical approach to moving this number over 18 to 36 months is definitely the way to go, even if you're a 50 or $100 million company. The culture, morale, all of the potential risks and other things that get introduced by doing that in a short-term fashion, that is not the move. That's not what we recommend.
Now, private equity sometimes can make those kinds of moves, and it's one of the reasons that these private equity deals can be really interesting. I saw Smartsheet just announced Vista, and I think BlackRock has taken them out. They perform reasonably well, actually, but that can be a time where you can make these types of changes, and everybody sort of nods their head and says, "Okay, that makes sense."
All right, I'm going to bring on Rianne. She had a great question that got a ton of comments and upvotes in the chat.
Hi, Rianne.
Hey, how's it going? Great to be with you all today. I work in go-to-market strategy, so really excited to hear from you, David, today. Everything you're saying around the go-to-market efficiency metric is resonating with me, and I think a few others in the chat here. But I think the question is, how do you action on what Chris was mentioning in terms of identifying the areas where we're wasting money by analyzing this go-to-market efficiency at lower grains in the business? Is it by motion, such as acquisition, expansion, retention, or do you go deeper into channels, or how do you operationalize this metric?
Yeah, I mean, that is the question, and this is why I befriend people like Chris and Jocko, because honestly, it's not my expertise. Now, I would be the equivalent of an FP&A guy, or maybe like if I spent enough time on it, a RevOps person. Honestly, those people should merge over time. They should sit next to each other. But I know from a finance perspective, and ultimately a RevOps perspective, what I would do, it would be what I talked about earlier, which is, all right, look at the components, right? So why did your growth go from 40% to 15%? Look at the gross growth in new logo sales and the growth in your upsell sales. Just look at those separately, break them out. Do not, look at this metric as one, because that's the way it's packaged here. But the next thing you have to do is say, okay, well, where did we whiff? And ideally, as you point out, like do it by motion, which shouldn't be that hard to do. And then, of course, on the churn side, and on it wouldn't just be like, well, which customers left us 100%, which have downsold to, but also like which cohorts, like what are the characteristics of the customers? Why are we selling to this particular group that 50% of the time churns within the first 6 months? Like, that's crazy. We shouldn't be doing that.
There was a podcast maybe 3 or 4 published ago called the Go-to-Market KPI Stack or something like that on the B2B Revenue Vitals podcast. I broke down basically our methodology in 6 different layers that start with go-to-market efficiency and growth rate, and then break that down into the financial metrics and the top-level investment metrics, and then break it down into unit economics and some other details, and then look at new logo and expansion renewal as 2 separate things, and then break it down even further between pipeline creation, closing new logos, renewing customers, and expanding accounts, and then categorizing your investments in that way, calculating it in each different area. And you could get like 400% go-to-market efficiency in a bunch of different ways. So here's 2 different examples. Company has 87% GRR and not getting a lot of expansion, so they just have this leaky bucket on customers. And then new logo, like they're humming 18-month CAC payback, doing a bunch of new logo revenue, but is not enough to sustain all the stuff that's being lost. So you're still at 400%, or you have 101% NRR and you used to be 120%, and all of a sudden your shitty new logo process and ineffective stuff starts to really put pressure on you. And so it can happen from both ways, and generally it's dynamic, but when you see it, then you can start to think about reallocating investments. Like the challenge for one company we're working with, like they spend like $15 million a year on post-sale and they lose $4 million in ARR from their base. Like it's a very negative ROI on that large investment. And so like, what do you do in that case? And then you get into the strategy component. Like, from my perspective, it's actually a lot easier to fix new logo than it is to fix NRR and GRR. It's process, product. You have to wait for cohorts of customers that churn in 2 years to actually flow through the 2 years and leave. So it's a much more complicated and a longer time horizon to resolve things like that generally. But on the new logo side, if your go-to-market efficiency is bad, it's because you're wasting a lot of money. And a lot of the money comes down to marketing programs and then just too many headcount on the SDR and sales side. So that's something that can be corrected a lot more quickly.
Yeah. And then just one of the things that we're doing. So number one, we've partnered with Winning by Design, which I know you're close with as well, Chris, to benchmark the bow tie metrics. So, you can look and see both for yourself as well as for the industry, like, okay, where's the breakdown? Is it the CR1, CR4? These are just technical terms for things like, marketing qualified leads, conversion rates, things like that. To the back end of the bow tie, of course, the renewals and expansions. And so you can see specifically which areas look like they're out of whack relative to the market or where they were for you a few years ago. And the companion app that I referenced earlier that we'll come out with in the next month or so, which is called BenchSight's SaaS metrics. You'll be able to look specifically at these metrics, this metric in particular, but also the components that lead to it, like, well, how much of our growth comes from new customers versus upsells. It's just so important. You don't get that from the public companies, but it's so relevant to this conversation of how do you fix it and how do you deal with it and what are other people experiencing.
And then I think it's important, like, if you take this and you make it into a different concept, like, what is the purpose of go-to-market efficiency? It's really to figure out where you are, right? If you're trying to get somewhere new, what's the first thing you need to figure out is, where am I, right? And so that number, if it's 200% or 500%, what's the distance that we need to travel? How big is this type of issue? What is the upside of it? And then you can start to dig deeper into attribution segmentation, looking at different go-to-market motions, looking at the allocation across departments, and do a lot of the custom stuff. But I've been talking for several weeks, like, the custom stuff must be done with a purpose to answer a top-level business question. And so the question might be like, why is our go-to-market efficiency at 500%? Then you look at new logo expansion, pipeline creation, you identify that. And then after that, then you go into attribution and say, why is our pipeline creation ROI so bad? And then you take the attribution and the more detailed stuff from there.
Awesome. A lot of heads nodding and a lot of people taking notes. We are going to go to David K.
Hello, David. It's a pleasure to have an
David.
opportunity to speak with you.
Thank you.
Been following you for a couple of months. Thank you, Chris, for bringing people like David and Jacko to the call here. So my question to you, David, is about these growth rates for individual companies as compared to the categories that they're in. Does your data source or sources give you any indication as to the overall category growth rates so that we can kind of benchmark against these individual companies? The thought that goes through my mind is that the category could be growing, but some of these companies within these categories may not be growing as quickly.
Yeah, it is a really good question to which there's not really not even a close to perfect answer. And the reason is there's only 80 companies here that are telling us what's happening. The first thing I'll say is that it's pretty stunning that the cut in growth is across the board. Like, okay, it's not true for ChatGPT, but I think for just about everybody else, obviously there's some exceptions, but if you look at the public companies, they've all been devastated by cuts in growth because the environment, now some a lot more than others, Zoom Info, is getting killed because they're in this go-to-market space and they sold to a lot of companies that were feasting on free money, more so than Viva, which sells to the pharma space. But even Viva's growth is down. So it is across the board, which I still don't completely understand. There's some pervasive stuff going on, interest rates, things like that, but still that's quite surprising to me. But to answer your question specifically, like, well, what about vertical market software in general? You can make some preliminary conclusions, but with, an N of 10, as in 10 companies, it's not enough. You really need more companies. I feel pretty confident that growth is pervasively down. But to answer your question, which if you're an investor, you really want to answer, is it down a lot more in DevOps than it is in security? You can get smaller answers, and I've addressed this a bit. I'll have more on that subject over time, but we'll have a lot more on that subject when we get data from private companies in this new SaaS metrics app.
Thank you. I appreciate that. The thing that goes through my mind is that there are just so many more competitors in each category now that these, in many cases, if they're public, relatively earlier movers, not early, but earlier,
Yep.
might be discovering that there's a lot of competition nipping at their heels growth is happening. It's just not with them. But just the unknown. Okay. Thank you so much. I appreciate your answer.
All right. We're going to bring on Mitchell next.
Hey, David. First,
Mitchell.
I think on behalf of us all, great work. And I'm really looking forward to some of that private data for sure. I guess my question is back to the kind of go-to-market efficiency metric. Obviously, it's broad, and it's fairly new or early in terms of bringing this idea to the forefront, and of course, it's nuanced. Well, my question is, I'm curious, based on your experience, how have investors, CEOs, CFOs reacted to this correlation between go-to-market efficiency and valuation? What's your sense? I'm sure the numbers are fairly small, but I'm just trying to get your early sense on that.
Investors probably aren't even paying attention. I mean, even though this is persuasive, maybe they should. I joked when I first looked at that chart a month ago, maybe I should start a hedge fund or something. But I think, I know a bunch of research analysts who cover SaaS companies. I worked with a number of them. I do talk to them. I think they pay slight attention to it, but I just don't think they're reacting to it. I don't know that I would invest based on it at this point, because as we've all pointed out, there are other things there are a lot of other things that lead you to understand why Datadog is such a great company. And they feed into this result of great go-to-market efficiency, but it's the underlying things that the investors like, and those haven't changed. So I don't think there's enough here for that. Maybe someday there will be. But ultimately, the investors, the good ones who are really getting into the underlying issues and opportunities for stock, are trying to get a grip on what is GRR at Datadog and Confluent. It's leading to the same types of conclusions. It's just, this is a great way to summarize it. I don't think people are looking at this and saying they're going to buy and sell stocks. At least I'm not ready to accept that responsibility. Let's put it that way.
Yeah, I would agree with that. But I do think that in the coming years, you'll see this type of calculation and deeper analytics in every single private equity due diligence process as a method to understand potential returns. And to value the company properly. They'll get there through EBITDA and cash flow. They'll get through on their own method.
I think they're doing it. It's interesting. I do think they're doing it in a lot of ways. And good investors have been doing it for years. There's a woman I worked with years ago at Battery, Chelsea Stoner. She's all over this metric. And so it's not new to them. They may have different names for it, but they get it. And especially true for the private equity community. You're exactly right, Chris.
Yeah, and they're getting...
I'd actually agree with it. Yeah, the private equity piece, I probably should have said the PE investors. And the second comment would be, I agree. Maybe it's a way to get into a conversation, to dig deeper. It's not going to replace the other, ways of doing DD on these companies for sure.
Yep.
But to roll it all up to say, I think we need to drill down a little bit deeper. I'm wondering if that is maybe the reaction that they had. Oh, interesting. Let's dig in.
No, I think, somebody said it could be infinity, and it could be negative, which means it's, not meaningful or the worst one on the page. But what you should do is figure out your motions, or however it is you want to look at your cohorts. And if your overall number's 400, guess what? Some of them are 1,000, and those are the ones you need to focus on.
All right. We've got two more lined up. Hopefully we can get to. I'm going to read this one for Lynn. She is driving. So her question is, what would you recommend as the best resource for strengthening financial acumen quickly to address the BOD from this approach?
I mean, there are a lot of good things you can do. I think the first thing that should be done is to kind of track a group of companies that are SaaS companies as they're reporting. I find one of the best things to do is to read the transcripts from the reports while you look at the press release will have the basic financials. That's a lot of data, but like a lot of things, if you start looking at a few of them, and you can skim these transcripts, they're all available for free now. Years ago, it was really hard to get them. But you can be pretty efficient at this, and it won't take long. And what you should do is, they're not going to say what their go-to-market efficiency is, but it literally takes 5 minutes to compute it. It may be less if you have it all in front of you. So you can play along at home this way, and that's the best way to just to consume this stuff. Pick 5 companies and the reporting happens basically about 4 weeks after their quarters end. So starting in about 3 weeks, 4 weeks or so, the new reports for Q3 will be coming out, and pick 4 or 5 companies, and don't pick Salesforce. Like, there's too much there. Pick Datadog and Confluent. Those are the ones to pick, or something like that, where it's fairly pure, MongoDB. And very quickly, you can get educated on this stuff.
That's a great tip and very actionable. So our audience will love that.
Awesome. David, thanks so much for joining us. I've been looking forward to this since we scheduled it like a month ago. The work that you're doing is so impactful, teaching myself and a lot of other go-to-market leaders how to look at this stuff, how to think, and be able to speak the language of someone that comes from the finance side or the investor side, I think is so valuable for people in go-to-market. So thank you for joining and sharing all the expertise.
Well, thanks for having me. I mean, I love what you're doing as well. And so it's an honor to be here. Thank you.
And thank you all for joining. Hope it was valuable. Shoot me a DM on LinkedIn with some feedback if you have it, if you want to keep doing more sessions like this. Or if on the chance that you wanted something different, just let me know. We're always trying to make this event better. So if you do feel compelled, please share that feedback and we'll take action on it. We'll see you again here next Tuesday. Thank you all for being here.